report today, the November the 8th. Let's kick off. Yeah, today, for today, I'd like to talk about the rising risks propelling the higher interest rates. What we're seeing right now is, as you all know, with the geopolitical things, it is also affecting with the interest rates of the market, and what is the relationship and what's going to happen next. I think that's crucial, and I'd like to discuss that today. Now, first of all, during wartime, what we're going through right now, it's common for investors to shift their money into safer assets like Treasury bonds. So when lots of investors buy Treasury bonds, their yield usually go down. Yield means the return usually go down and the bond prices rise. Okay, so it's an inverse relationship. So as when to buy the bonds, it get more expensive, of course your return will drop, right? So the current environment is rife with geopolitical tensions. Okay, and it's around the world, and it's currently what we're seeing right now has the potential to upend supply of key commodities, thus making it harder for investors to look for safe haven assets to park their money. It's not that easy. Everywhere at the turn of a corner, you're seeing things. It's not that easy to invest, to where to park the money in a place where we call it as safe, right? So this could explain why bond yields have been going up and may stay high for the foreseeable time. As they can't find any other safe haven assets except bond yields, the bonds, right? So they are like parking the money there instead. Okay, so look at the recent conflict between Israel and Hamas. Okay, it's causing worries about a bigger war in the oil-rich Middle East, right? But we're just lucky, right now things are cooling down, but it's not that easy. We are still treading in like a very, very thin line over here, and we can just shift into that mode, where the war can erupt anytime. So we have to be very, very careful. Not we, the world has to be very careful. And the World Bank has said that, if this war will erupt, right, go something really and involves the Middle East and so on, oil prices might jump around to 85 to 150 US dollars per barrel in the worst case scenario. And that's not good, because if you're talking about bringing down inflation, this is not going to help, definitely. And we are going to see the exact opposite happening. So in situations like that, when oil prices rise, right, inflation could spike again, and the Federal Reserve might have to raise interest rates further, and this again will lead to higher bond yields. You see, so with this kind of potential things happening, that is no wonder we are always seeing bond yields right at the top, right there. So last year, the war between Ukraine and Russia, a lot of people forget this already, to be frank, and you seeing Ukraine is trying to say, hey guys, remember, I'm still here, I'm still fighting a war, don't forget about me, because we don't see this much. Everything is just about the Israel bombing Gaza every single day. You're seeing that in the major news portals, right? So when the Ukraine and Russia war, when that happened, it messed up the oil and gas supplies and put our food supply at risk as well, right? We have seen that. So if you add that thing together with the tension between US and China, with all the tariffs and trade limits, we actually have all possibilities that could disrupt the flow of many goods and commodities. Okay, so these are the reasons, like why the yields are still so high. It's just not about that small thing here and there and here. It's actually the geopolitical tension that's going around this whole world right now, right? So as discussed before, in the previous reports, right? The rise in the term premium that the lenders demand for safety to compensate the potential rise in yields has added to the borrowing costs. And it has allowed the Fed to keep raising interest rates last week, right? But if we still get inflation surprises from abroad, okay, then the Fed might have to hike the interest rates later on. Not now, but later on. Now, we have seen Biden doing a lot of things to prevent this, right? So even if Biden is successful, US is successful to shield the US economy from geopolitical supply shocks, right? By favoring domestic production through various tariffs and subsidies, it could still bring their own inflationary risk inside there. And because when you avoid cheaper and advanced tech, like from China, they are still the biggest clients, from of China, for example. Like if you don't want that, you have to do it on your own. And that's going to mean that you're going to have higher energy costs because you're building things on your own. Everything is on your own right now. Yeah, energy costs are going to go up. So if you bring back all this production back to US, right? Experts believe that, it could make borrowing and interest rates also go up as well. It's the same thing because we are operating in a different time right now where the risk is high. So when risk is high, of course, people need extra protection, and that is actually higher borrowing costs. So these are the reason why we are seeing that the US 10-year bond yields actually hit 5%. It peaked there, but from there it has dropped to test 4.5, and currently it's around 4.64 when I wrote it, but to this morning it's about 4.579, right? But this thing has to come down again. The yield here, okay, the yield here has to go down to 4.5 again, and stay there if it's expected to decrease in the short term. If not, this thing can go all the way to test that 5%. But nonetheless, the news that's coming out this morning is that Biden is working very, very hard. The US is working very hard to advise the Israel to temporarily cease fire, call for ceasefire. Okay, and with this, right, then you see everything started coming down. You have seen gold also started to come down. Anything that has to that involves tension that's been going up since, like oil is one more. The price also come down. But don't think for a second that this thing is going to come down and won't go up already. There is all potential for it to go up because it's a ceasefire, and Israel has, in a way, said that they are not going to stop this unless all hostages are released and Hamas, right, surrenders unconditionally. And this is not something that's going to be easy. We have to know, okay? So whatever you see, this is temporarily. That's why I'm not like, I personally hope that it's permanent, but yeah, it's not that easy, okay? It's not that easy. I think it's just temporary before they start again moving deeper into Gaza. So I hope that this one answers some of your questions with regards to why interest rates stay at elevated levels, why the yields are still also at the elevated levels. All these are contributing to it. Okay, so what we hope right now is for a dial down in this tension, and you start seeing things moving back into conditions that is much easier to anticipate, because whenever we have question marks in the market, investors, they don't like question marks. They like certainty. They don't like uncertainty. As long as there's uncertainty in the market, then you will always see this tension happening. You will see volatility at the very, very high. We have seen that. You have seen that in, like, you see patterns like what's happening in the natural gas. Whenever I come to the chart, so it's in a very complex structure, and true enough, if you've been following the natural gas, you are seeing that. So commodities will go through that. You have commodity currencies also going through this kind of patterns, very high volatile patterns. They're very big swings either sides. Or these kind of things are natural occurrences during times of uncertainty. Okay, so with that, that's the end of the fundamental report today. Let's move on to the charts, right?